Hello everyone, and welcome to NorAm Drilling's investor presentation. My name is Marius Furuly, and I'm the company's IR and Strategy Director. With me on today's call from Houston, I have the company's CEO and CFO, Marty Jimmerson. We will do a quick presentation, and then we will host a Q&A towards the end. And I'll just leave the floor to you, Marty.
Marius, thank you for the introduction, and it's my privilege to present to you today NorAm Drilling. Let me begin with the obligatory disclaimer statement that we're required to inform you of. I'm sure you're aware of it. If you aren't, please read the disclaimer at your convenience. So NorAm Drilling, what are we? We are an owner and operator of 11 ultra super-spec rigs. We work in the most attractive shale basin in the United States, the Permian Basin. We're 100% focused in the Permian Basin, and we have over 15 years of operating history. Today, approximately half of our rigs work for the same customers that we were working for in 2016, which proves the long-standing customer relationships and operational excellence that we operate with at NorAm Drilling. NorAm has benefited from a strong ownership group through the Sea Tankers Group that has allowed us to build 9 of our 11 rigs, acquire 2 rigs, and upgrade all of them to our ultra super spec rigs. We are the industry leader in terms of margins as a result of our efficient cost structure and low maintenance CapEx. What is an ultra super spec rig? Some people call it a tier 1 rig. We call it an ultra super spec rig. Here we're giving you a depiction of what a typical pad looks like. The pad, outlined by the red line at the top and the side and on the bottom, is a pad that our operator will drill multiple wells per pad. As you can see, kind of moving left to right on the outskirts of the boundary, there are operator and crew quarter houses where our people sleep and work from the house. In the middle of the picture, you can see the derrick. The derrick includes the ability to rack 25,000 of 5.5-inch pipe. And this is important in terms of what is happening in the Permian Basin today. We utilize high torque top drives and iron roughnecks that are capable of breaking the high torque connections that are required for the longer laterals that are being drilled in the Permian Basin and generating the significant oil production. We also will typically walk from 1 to maybe 6 or 7 different wells on this one existing pad. When we walk, the rig and the derrick actually will move 25 feet or approximately that amount in probably a 3 to 6 hour period. And then we will drill another well. When we originally come on location, it typically takes about 14 days to drill one well. So you can see that the benefits of having a rig capable of walking across multiple wells can significantly save money for our customers. Additionally, we utilize catwalks down here on the lower left that moves the pipe up into the derrick and takes it down out of the derrick as we move the rig. And then we have 3 mud pumps, 4 engines, and AC generators controlling and powering our rig. This today is the state-of-the-art rig in the United States shale basins, and it is the preferred rig of choice in the U.S. today. Let's talk a little bit about Backlog and our customers. So the onshore land drilling business is a business that is accustomed to signing contracts anywhere from pad to pad up to 1-year contract terms. As we entered 2022, our current average fleet day rate of 28,000 has increased 50% since the beginning of the year. This is a result of maintaining a strategy of keeping contracts on a short-term basis. We're essentially sold out through the end of the year, and we are starting to have discussions with our customers about the renewals of contracts as we enter into 2023. As you can see, we have contracted rigs through a portion of 2023 that are well above a $30,000 day rate, which we think the current spot market for our rigs and day rates is in the low $30,000 range. We're very proud of our customer base. We believe the gold standard starts with working for ConocoPhillips. We also work for Diamondback and Callan. All three of those are publicly traded operators. We have a long history of operating for Crown Quest, who we have 3 rigs working for today, and Firebird Energy. We also have another 3 rigs. In summary, we're very well positioned to continue to take advantage of what we see to be increasing day rates in the U.S. land drilling business. Our management team and board of directors have been together for a very long period of time, and we have a significant operating history together. The company is based in Oslo, the parent. We operate out of the Houston office, and we have an operations control center in Odessa. We have today 315 employees. 290 of those are assigned directly to the rigs and responsible for the daily operations of the rigs, including our rig managers, our drillers, our operational overhead support staff. We have over 100 employees who now have more than 7 years of tenure at NorAm Drilling. Impressively, we have 3 employees who have been with the company since the very beginning of time. We think that this is what helps differentiate NorAm Drilling, given our understanding and consistency of maintaining crews on our rigs. Now let me talk a little bit about our cash break even. We talked about earlier about our industry-leading margins that we earn. It starts with a cost structure of $16,700 a day. That includes $14,000 of operating cost at the rig on a daily basis. The majority of that is labor cost and routine R&M. Additionally, we allocate all of our overhead and our SG&A into this number, which is the equivalent of $2,000 a day. And again, I would like to reiterate, we get synergies from operating out of one cost center in Odessa and helping us be more efficient. We also assume that we'll spend $700 a day of maintenance CapEx. So all in, we're at $16,700 a day. As you can see, we talk about day rates on the left. If we're at signing rates at 30,000 or higher today, that would give you incremental margins of $13,300 a day. And if you were to extrapolate that over a full year, moving to the right, that would show or demonstrate that we have the capability of paying out over $50 million to our shareholders in the form of dividend. And at our recently completed IPO listing of 40 NOK, that would give you a dividend yield in excess of 30%. Let's talk about the macro market briefly. So I think we're all aware that the demand for oil has returned to near pre-pandemic levels, and that is even with China not fully online as of yet. The spare capacity continues to decline globally, and we expect that trend to continue. As recently as this week, OPEC is announcing that it intends to further cut production to support oil prices. We expect the U.S. shale play to continue to be a dominant contributor to both the existing demand and supply of oil, as well as what we expect to be an increase and the need to produce more oil in the near future. Further kind of impacting the outlook for oil demand is the fact that the investments around the globe and specifically in the U.S. continue to decline in terms of the cash flow that's being generated. Prior to this upcycle, it was normal that the operators would spend more than they were earning. That has changed. Today, there's no credit available. And secondly, our customers are looking to return yield to their shareholders. The chart on the right, you can see since 2021 in the first quarter, our customers have continued to distribute the majority of their free cash flow back to their shareholders. And while they have increased their investment capex over the quarters, the majority of this is associated with cost inflation and is not necessarily indicative of increased production. They're maintaining production at these levels. So if you believe, as we do, that global oil demand is going to increase, we're going to continue to have trouble and challenges without further investments of maintaining our current supply, and that we'll need to produce more oil. The Permian Basin is a very attractive opportunity to participate. Today, the Permian Basin generates 60% of the U.S. daily supply of oil and 5% of the global demand. So it is a significant contributor. You can see on the left graph where the Permian far exceeds all of the other basins. The key to operating in the Permian is you need to have ultra super spec rigs that can drill 25,000 foot wells, handle the high torque intensity of the wells, and drill multiple wells per pad. Today, there are roughly 750 rigs working in the U.S. and 350, or almost one half of today's rigs that are working in the U.S. are working in the Permian, and over 90% of those rigs working in the Permian today are ultra super spec type rigs. As of today, we are completely sold out of ready, available, and crude super spec rigs. Let's talk about something called the drilling but uncompleted wells, or otherwise referred to as DUCs. Since the pandemic, the number of DUCs have declined, specifically in the Permian, by almost 75%. This was a direct result of lower oil prices and our customers drilling the well or completing the wells that they had previously drilled in the most efficient manner to get oil to the market. Well, now we're down to less than almost 1,000 DUCs remaining. And my personal belief is there is a good portion of these DUCs that will never be completed, either because they're not viable or they're just not going to be completed. Therefore, in order to continue to supply and meet the demand of global oil supply, we will need to continue to drill more wells, and the Permian is well positioned for this need. Now let's talk a little bit about some financials. As you can see, in 2018 and 2019, we generated in the mid $20 million EBITDA range. Even with the pandemic, when we started 2020 with all 11 of our rigs working, and we went down to 4 rigs working in July of 2020, we still earned EBITDA. We have never required any assistance from our shareholders during this period, and that is due to the financial discipline and the quality of our rigs that we have been one of the first drilling contractors to return all of our rigs to work post-pandemic. When our rigs are contracted, we typically earn a 99.5% utilization, meaning we're earning day rate 99.5% of the time. Below that, you can see our historical day rates. In 18 and 19, we were earning in the low $20,000 range, and that was somewhat of our same average at the beginning of the year in 2022. And as I stated earlier, we are now signing contracts above 30,000, and we expect that to continue. Let's speak to CapEx briefly. So in 2018 and 2019, we spent $34 million on CapEx. 31 million of that 34 was associated with the acquisition of 2 rigs that we upgraded to ultra super spec, meaning only 3 million in 2018 and 19 and another 5 million in 20 and 21 have been spent on CapEx. The majority of that residual 8 million has been to complete our ultra super spec upgrades. And again, given the age of our fleet, our preventative maintenance that we operate our rigs with, we believe that we have a nominal or minimal amount of maintenance CapEx that's required. And with that, let me leave it to Marius to cover the next word, and then we'll take some questions and answers.
Thank you, Marty. So let's talk a little bit about the repricing potential of the NorAm stock. On Friday, the 7th of October, the company shares will start trading on Euronext Growth in Oslo. And as you can see on the left-hand side of this chart, if we were to be priced at a 25% discount to the Big Four, which is essentially our 4 largest publicly listed peers, being Patterson, Precision, H. Helmerich and Payne, and the Neighbors Industries, we would be trading at the 40 to 73 NOK per share range with a $30,000 to $35,000 land rig rate. On the right-hand side of that chart, we see the implied pricing of our shares given new build parity and also the replacement cost of building a new rig. There's currently not being built many, or there hasn't been built any rigs in this industry since 2014. So the replacement cost of a new rig is a bit of a theoretical number, but we expect it to be at least 30 million in today's market. On the right-hand side of this chart, we just illustrate the power of a yield pricing on our stock. In a $30,000 per day scenario, given a 15% dividend yield pricing, our shares would be trading at around 80 kroners per share. However, we see that rates are exceeding $30,000 per day on new contracts, and we would expect it to be higher if the current strong momentum continues in the market. So at the $35,000 day rate, a 15% yield would imply a share price of more than 100 kroners per share. There are certain market analysts out there who says that market rates even could go as far as $40,000 per day, and in a 15% yield pricing scenario, that would imply a share price of around 114 kroners per share. So we are, as a company, quite sensitive to day rates, and just as this slide shows, the power of higher day rates could be enormous for a share price. And with that, I would like to open up for questions. And because we don't have any other guests in this studio, I will like to ask Marty three questions. And my first question to you, Marty, is you talked a little bit about the specifics of the ultra super spec rig, but how did a super spec, or how did a tier 1 rig look like back in 2014?
Marius, great question. So in 2014, a super spec rig, not an ultra super spec rig, while it had walking capabilities, the main difference is that it could only handle 5-inch pipe and roughly 20,000 feet of 5-inch pipe. Today, we're using 25,000 feet of 5.5-inch pipe. So that is a structural difference in the rig. The key is, and as you can see here on a picture, you need to be able to rack or stand up all of that pipe in the derrick, and the rig can walk from well to well. If we were required to lay down that pipe in order for the rig to walk to the next well, that could cost the operator an additional day of the operator paying us while our rig is walking over. So it's very, very economical to have this capability. Furthermore, as a result of going from 5-inch to 5.5-inch high torque pipe, as well as going an additional 5,000 feet, the ultra super spec rig requires a fourth engine. It requires a high torque top drive and essentially a high torque iron roughneck that can break the connections. So bottom line is, as the wells get deeper and longer, you need heavier duty equipment to be able to meet the demands in order to operate in the Permian.
Thank you, Marty. And my next question is, a lot of the audience here is likely to be familiar with offshore drilling and offshore drilling contracts. How is onshore drilling contracts different to offshore drilling contracts?
Well, I've been in both businesses, so I know them pretty well, much like our audience. So the offshore business is accustomed to 3 to 5 year contracts, and all the investors want to know about backlog. In the U.S. land drilling business, as I stated earlier, this is a business that has historically only signed contracts with durations of pad to pad, which could be 30 days to up to 1 year terms. There have been very few or no contracts beyond 1 year terms. Historically, if you did get a contract beyond 1 year, it was associated with a new build. And the last new build that we're aware of straight out of the yard was in 2014 and 2015. So since then, this is an industry that operates on contract terms less than 1 year. As we entered 2022, our preference was to be somewhere in the middle of a pad to pad to a 6-month contract so we could take advantage of what we saw as increasing rates. We continue to see the increasing rates, but we're also seeing our customers be much more interested in signing contracts anywhere from 6 months up to a term of 1 year, because they have the sense or they're starting to realize that we are completely sold out of available, crude, hot stacked, super spec rigs. And so they know they need to tie these rigs up, because if they lose a rig to a competitor, there's a good chance they will not be able to get another rig for a minimum of 3 months to possibly 12 months. So it's very important that to our operators, and you can see why they're starting to lean towards longer term contracts.
Thank you, Marty. So my final question to you would be, okay, so the oil price is relatively high. The operators using you, they earn a lot of money currently, and 30, you also own a lot of money. So how do you see the development in the new supply of land drilling rigs in the US currently?
Marius, you know, sometimes you finally figure out what you've done wrong in the past. And I've been through several cycles in this business. In previous up cycles, it was a rush to get as many rigs to work as you could, as quickly as you possibly could, for the privilege of earning $2,000 to $3,000 a day of cash flow. Today, the world is different. Our operators, my competition, NorAm Drilling, the oil field services companies, they are absolutely steadfastly focused on returning money to their shareholders. The rigs that are working today have already been upgraded and will continue to work. The rigs that can come into the market, depending on who you talk to, the majority of them are either owned or controlled by what we refer to as the Big Four, which would be Helmerich and Payne, Neighbors Drilling, Patterson, and Precision Drilling. They each have their own debt level that's requiring a utilization of their free cash flow that they're earning, and they're also returning money to their shareholders. Thus, the ability to upgrade rigs going forward will only come about, and our competition has stated this publicly, will only come about if they get day rates in the mid $30,000 range and they get contract terms that justify the CapEx required to reactivate these rigs. Depending on who you speak with, it could be as low as $3 million to reactivate a rig. We happen to think that it's going to be higher than that, probably double, near $6 million per rig. And it's only going to increase if there were more rigs to come in the market. But let me close with this, Marius. The biggest moat around the ability to put more rigs to work. Yeah, we can put money at a rig, we can find the components, and we can upgrade a rig. But the biggest moat is labor shortages. We have already crewed up all of our rigs. We're working. And to crew up a new rig, our understanding is that in order to find 25 new hands that have probably never worked in the business, you're probably going to have to recruit 300 people just to crew that rig on day one. The turnover remains high in this industry. It's a very challenging and difficult market to work in. And today's society, that's a different breed. And so you've got to really go through a lot of labor to find a crew that is as consistent as NorAm Drilling's. So while I do think there could be a couple more rigs that come into the marketplace over the next 12 to 24 months, I don't think it'll be like it was in the good old days of the Wild Wild West, as I like to say in Texas. So with that, again, I think the supply of rigs is going to be muted based upon financial discipline and the lack of available labor to be able to crew rigs as we move forward.
Thank you, Marty, and I think you summarized it quite well there, because the other peers that are listed in this industry, they are typically associated with relatively high debt levels, a relatively high portion of their fleet still not in operation, and at NorAm, which is virtually debt-free and have all the rigs in operation, the investors of NorAm will reap the rewards from this big growth in day rates first compared to the other listed vehicles. So with that, thank you very much, Marty, calling in from the NorAm headquarters in Houston, and I will thank you all for listening in, and thank you.